The crypto market is crashing right before our eyes. We've got Bitcoin and Ethereum and many other cryptocurrencies going back to price levels they haven't seen since 2020. We've got another stablecoin, USDD, which has depegged from the US dollar, and we've got Celsius Network and Binance, which are some of the biggest crypto lenders in the world, freezing all account withdrawals. We've got layoffs and hiring freezes happening all around the crypto world, and most crypto-related stocks are down big. And we've got inflation. All of these events have led to more than $200 billion being wiped off the cryptocurrency market in just the past 3 days. In fact, the overall cryptocurrency market capitalization fell below $1 trillion today for the first time since February 2021. Now, even though there is a lot happening in the crypto market, with today already being dubbed as the Crypto Black Monday, for me, all of this chaos can really be attributed to 3 key factors. The first factor is inflation, the second factor is the stock market and gold, and the third factor is the loss of trust, primarily due to Celsius Network and Binance halting withdrawals. In this video, I will provide you with concrete data and research so that you can make sense of all of this madness, and all I ask of you is to hit that like button and please consider subscribing. Let's start this video talking about inflation and how it impacts cryptocurrencies. Put simply, inflation is at a 40-year high, and it is sending the prices of everyday goods like groceries and gas and all of our day-to-day living expenses through the roof. And when inflation rises, as it has recently, history tells us that consumers tend to pull back on spending because their money doesn't go as far as it used to. But there is a very interesting phenomenon that happens anytime inflation goes up. When inflation spikes, it almost always causes investors to flee risky investments, and cryptocurrencies are viewed as some of the riskiest investments on planet Earth. Now check out this 1-month Bitcoin chart. And as you can see, over the past month, Bitcoin has remained relatively steady at about the $30,000 price level. But after the consumer price index numbers were released on Friday, showing that inflation had hit a 40-year high of 8.6%, Bitcoin's price came crashing down by over 20% and officially dropped under the $23,000 mark for the first time since December of 2020. Now, there are a lot of people out there that believe cryptocurrencies, particularly Bitcoin, serve as an inflationary hedge, but I would argue that the data tells us otherwise, because it wasn't just Bitcoin that got absolutely obliterated over the weekend. As you can see from this data from CoinDesk, which shows the 24-hour price movement of the biggest cryptocurrencies on planet Earth, just in the past 24 hours, Bitcoin is down 16%, Ethereum is down over 18%, Binance Coin is down almost 15%, Ripple is down over 12%, Cardano is down over 12%, and Solana is down almost 17%. So in short, inflation is one of the biggest factors impacting the price of Bitcoin and other cryptocurrencies. Now let's move into the second reason why cryptocurrencies are down big, and that has a lot to do with the stock market and commodities, particularly the tech-heavy NASDAQ 100 and gold. For years and years, Bitcoin has been touted as digital gold, and many investors touted it as a safe haven investment for the type of market environment that we are in right now. In short, we are in a very tumultuous market environment. Inflation is at a 40-year high, the stock market is getting absolutely hammered with the S&P 500 down over 20% year to date, and a recession looks like it's inevitable. Perhaps the worst part of it all is that we don't know when this bear market is going to end. It could last 1 week, it could last 1 month, or it could last 1 year, or perhaps even longer. And during periods like this, which are essentially periods of economic uncertainty, investors want to protect their money, and for hundreds of years, gold has always served that role, and that's why they call it a safe haven investment. But more recently, particularly over the past few years, Bitcoin has also shown characteristics of being a safe haven investment because its price movement has been somewhat correlated with gold. But recently, something really interesting has happened. Since the beginning of the year, Bitcoin has become less and less correlated with gold and more correlated with the stock market, particularly the NASDAQ 100 index. Take a look at this chart that was published by Der Gold Report on Twitter. Now, the gold line at the top of the chart is the price movement of gold, and the bottom 2 lines are the prices of the NASDAQ in blue and Bitcoin in red. But what you need to pay attention to is the bottom 2 lines. The upper line represents the correlation between Bitcoin and the NASDAQ, and the lower line represents the correlation between Bitcoin and the price of gold. Since 2019, the correlation between Bitcoin and the NASDAQ has had periods of high correlation and periods of low correlation. There really isn't too much conclusive evidence to make any concrete assumptions. And the same can really be said about the Bitcoin and gold relationship. There have been periods of high correlation and periods of low correlation. But the interesting thing about this chart is the correlation between Bitcoin and the Nasdaq since the start of 2022. They have been highly correlated. Now, for those of you not familiar with correlation, a correlation of 0.75 or higher means that the relationship between two variables is highly correlated. And as you can see, the correlation between Bitcoin and the Nasdaq has been highly correlated since the beginning of the year, with extended periods of a 0.75 correlation or higher. Now, the reason that this is important is because this correlation shows us that the sentiment surrounding the Bitcoin market is changing. Instead of being viewed as a safe haven investment like gold that is relatively safe from inflation and safe from geopolitical events, recent data tells us otherwise. Bitcoin is actually becoming more and more correlated with the stock market, and many investors expect this trend to continue, and this in itself is triggering a sell-off that is gaining momentum. Simply put, investors and the general public are losing confidence with Bitcoin and other cryptocurrencies as a safe haven investment, and this is and could continue to drive the price of these cryptocurrencies lower and lower. And this leads me to the third factor impacting the price of Bitcoin and cryptocurrencies: Celsius Network. Celsius Network is one of the largest crypto lenders on the planet. And just last night, Celsius Network told users that it was pausing all withdrawals, swaps, and transfers between accounts due to extreme market conditions. In a blog post, the company said, and I quote, "We are taking this necessary action for the benefit of our entire community in order to stabilize liquidity and operations while we take steps to preserve and protect assets." And this news, along with a similar event at Binance, caused a lot of fear in the cryptocurrency market and played a huge role in the recent price decline of cryptocurrencies. Celsius isn't some small crypto startup. According to their website, they manage $11.8 billion and they have 1.7 million users. And on top of that, they recently raised $750 million in funding late last year. So this is by no means a small company, and this is by no means a small event. But in my honest opinion, the reason that these two events at Celsius and Binance have really shaken the crypto markets is because investors are losing trust. On their website, Celsius touts that you can earn an annual percentage yield of over 18% on cryptocurrency deposits. And for years, many people have questioned the business model behind these high annual yields and argued for transparency and argued that these types of yields are unsustainable. And as I mentioned, investors are losing trust because this Celsius and Binance mishap comes on the heels of the Terra USD stablecoin and Luna cryptocurrency collapse, in which investors lost billions of dollars just last month. And just today, the Tron network stablecoin USDD lost its peg to the US dollar, dipping to as low as 91 cents, which is also a terrible look for the entire crypto industry. So although these could be isolated events, many investors look at these events as a broader risk to the entire cryptocurrency landscape. And on top of the loss of trust, there is also the risk of contagion to other crypto lenders, other cryptocurrencies, and events like this mean that there is the risk of contagion to traditional financial markets. I was recently reading a write-up from JP Morgan strategist Nicholas Panigurtsoglou, and he said, contagion here is not via linkages between the crypto ecosystem and the traditional financial system, but via retail investors' sentiment. He goes on to say that if the $1 trillion capital loss in crypto markets causes broad-based retrenchment by retail investors in other risk assets such as equities, then that's where the spillover is. What he's saying is that many crypto investors now are traditional retail investors investing in the stock market. And as the crypto market begins to buckle and show signs of instability, many investors associate the same risk and instability in the stock market. It's been a crazy day in the crypto world, and I'm hopeful that you all found value in this video. And with that, ladies and gentlemen, I'm gonna call it a video. My name is Ravi Wadden, and I'm not selling anything. I just provide free financial education. So if you could please like this video and please share this video, it would be greatly appreciated. Thank you all for watching. I will see you all next time.